Hello and good afternoon. My name is Gavin Maguire. I'm Senior Equity Analyst over here at Briefing.com. Post under the Event Trader. Event is my ticker. And I'm being joined with by Dennis Hobein, who's our IPO Equity Analyst, who posts under the IPO and Relative Value Trader, or IPOXX and RVALU Trader. So today we're basically going to take a look at, this is more or less an introduction to our commentary and how we can help provide you some value and service on this website. So first we're going to be covering my commentary, the Event Trader commentary. Basically, the overall aim of this webinar is to explain how my comments work, breaking down the day ahead, breaking down the week ahead, looking at some past examples that I've covered, and looking at two items that are on the horizon that are going to be actionable events: the April Redeterminations and the upcoming Brexit. So basically, a focus of mine over here at Briefing is covering the daily flow of headlines. The idea behind this is trying to filter through the white noise of market comments that are making their way through, avoiding market moves on headlines that may be old or misleading, and providing running commentary on the key issues, both intraday and for the day ahead comment. The focus of the day ahead comment. The focus of the comment is a macro-based comment, but I will provide individual stock commentary. The goal is simply to recap key overnight events, how these are impacting the trading of U.S. futures and overseas markets, and what to expect in the United States for the day ahead in our markets. The introduction focuses on the narratives that are being considered to be the driving forces behind markets, and we're looking at either debunking these theories or providing some underlying trading events that could be impacting us. We'll then wrap up the comment on how it impacts the trading day and what to look forward to. At the bottom of the comments is a recap of the key news and events. So taking a quick look, this is a comment that I had today out where we just kind of broke down what everybody was looking at, the underlying dynamics, the move bumping ahead into resistance, and then, noting that the Fed was approaching, and then recovering the Bank of Japan comments, the China Tobin tax that was impacting markets overnight, taking a quick look on the more micro level at Jefferies and how that could impact some of the investment banks. And then you see at the bottom of bottom line, and then on that, you see a recap of the events that were out overnight and what we're looking ahead. So the next comment that I will be working on is the week ahead comment. This is provided on Friday afternoon, and then I repost it on the morning ahead. The goal here is just to provide an outlook of upcoming events for the week. At the beginning of the month, too, we'll do a looking ahead feature. Basically, the idea here is to avoid any surprises from the week ahead. The initial paragraph provides commentary on how we ended the week, and then I'll provide commentary on the 3 or 5 top events scheduled for the week. The comment is broken down into 4 categories, which include U.S. economic data, including Fed speakers, geopolitical events, etc., earnings, which I would also note is the basis for our earnings preview schedule. So if you're curious at what earnings we will be looking at in the week ahead, this is a good place to come. Then international economic data, and also conferences and corporate events that are coming up, which will include analyst days, shareholder votes, etc.
They're saying, okay.
If you hold on a second, it appears some of you might be having some difficulty with the sound. We're just going to take a quick look at that. All right, we're going to continue to move ahead here. There seems to be some mixed reviews on the sound, so we have our tech people taking a look at that to see what's going on. But so anyway, moving ahead. So we're going to take a quick look back at commentary that we've been taking a look at, given running results on, and that first one we're going to take a look at is the Grexit, which, as you can recall, last spring, the fear of Greece leaving the Eurozone captivated markets. There's endless headlines from various officials saying they were in, they were out, that a deal was being done, providing plenty of intraday daily moves in the market. Yet overall, the market remained on a firm upward trend. So our basic goal for here was just to make sure that nobody was getting too concerned over what was going on, avoiding sensationalism in the press. So here we can take a look at, and you can see from the February to July time frame is when most of these events were going on. And the market continued to rise higher and actually made a 52-week high in the month of May. We're just providing ongoing commentary, basically trying to talk people down to relax and work our way through the comments that were coming at us. Key aspect of the coverage was commenting on news and whether or not it changes the narrative. Who is saying it, and do they have any significance? Should the markets be reacting to this, and is it interpreting events correctly? And are there key technical levels that could be at play? A lot of the times you'll see rumors or items of this nature coming across right when we're either trying to break out or if we're trying to hold support at a key level. So we always kind of try to keep this in play when making our bringing into account what's going on in the markets. So here's a basic comment that we had during it from July 7th, which we were basically discussing the 200-day moving average. This was right around the time when Greece was heading to a major vote, and a lot of people were nervous that it wasn't going to go through. Yet we kind of downplayed what was going through and continued to point out the holding of the 200-day moving average. As you can see down in the later part of it, the basic key takeaway for the U.S. markets is that while we continue to gyrate, Greece and China support levels are holding. Here we can see the activity that was going through, and the red line there is the 200-day moving average. So just kind of providing what technical levels are staying in play, what the overall trend of the market is, and to avoid overselling or overbuying on any such headlines. Here's another key example of a Varoufakis headline that had made its way across wires, which I had pointed out should be faded. Basically, it was a comment saying that a deal was on the table. At the time, Varoufakis was on his way out, and most people took it as, okay, this is a done deal. However, we kind of wanted to hold people steady, not get in, jump in and buy, and actually to look for a fade in the action. So that very next day, as you can see, we would close at 20.95 and would open the next day down approximately 40 points at 20.64, and you can see the drop down there. Again, though, holding the 200-day moving average, which would move into the commentary lexicon. So a more recent example of this would be the European Central Bank. Obviously this week it was, or last week it was a major event with it on everybody's radar. We started providing the coverage a couple weeks ahead and then running commentary up into it. So as an example of the comments, we were looking at it as a sell the news reaction. But people did want to see what was to offer first, which kept key support levels in play. Basically, as I noted, though, we're looking for a quick sell-off as we're bumping into resistance. And headlines prior to this kept continuing to see an underlying inclination for markets to sell. Here we could see the action on a 60-day where we saw the quick pop on the Draghi headlines that rolled over into a sell the news. However, we were able to find support level with regards to it. So we were more or less just keeping people working up into it. And then once the package did come out, to point out how strong of a package it was, and to just note some of the action that would provide some underlying support, which did come into play. Here's basically a final comment that happened right after, which we discussed the upcoming BOJ, the China announcements that were expected, and of course tomorrow's Fed announcement. This was a preview where we noted some of the activity that was coming up, discussing deposit rates, asset purchases, to prepare everybody for these comments. This was part of our looking ahead comment for our week ahead, which we outlined some of the broader ECB decisions, the FOMC decisions. So this is just an idea of some of the commentary that we provided in the past just to cover these events, to keep you from getting sidetracked, sideswiped from any headlines and any upcoming comments that were coming out. So that brings us to two actionable events that we're going to be looking at coming up. The first one is the April redeterminations, which will be out over the next couple of weeks. This is basically reserve-based lending redeterminations for the oil and gas companies. The RVALU is basically an asset-backed loan which exploration and production companies use to borrow against. The loans are secured by the value of oil and gas assets on the books. The process determines the borrow capacity for oil and gas companies. It's a comment you're going to be seeing a lot coming up. I'm sure Scalp and Cont'd will also be discussing this in great depth coming up, because it's really going to make a change in how we view some of these oil and gas names over the next few weeks. Basically, what the redetermination process is banks will hire outside engineers to calculate proved reserves for these oil and gas companies. There's no standard methodology that is used for calculating this spread, so one of the key things we'll be looking at is commentary from the banks coming out over the next couple of weeks, including, of course, the upcoming Q1 earnings season. This process is done twice a year, in April, which is the spring one, and October, which is the fall one. Lender appetites will play a key role, which brings us back to covering the bank's discussions on this. Also, hedging and cash flow will be important determinants, which we will be taking a closer look at for some key plays. What can happen here? Basically, the key concern is that borrowing bases may be lowered for some of these banks, or for some of the oil and gas companies, I should say. Oil and gas companies could be forced to use other credit facilities in order to cover upcoming activities. This removes potential liquidity from oil and gas markets, which obviously at this point is greatly needed. And this is the money that the companies will be using to explore, complete, and drill new wells. All this could be compromised. And this could force to do debt exchanges, sell assets, seek third-party lenders in some situations, or potentially seek Chapter 11 as an end result. So these are all going to be key events coming up. The fall redetermination, there were a lot of fears moving into it, and this is when Brent averaged $54 a barrel, and WTI was trading at $50 from the May through October period. So obviously, oil's dropped even further from that over the past couple of months. The fall redeterminations did come in better than expected, but that has a lot of people thinking that it's a kick the can down the road event that will be coming forth in spring. A quick sample of 61 borrowers, we see 49% of them had their base reduced, 11 by over 20%. So this could be an event that could cripple a lot of borrowing needs for these guys. Now, not everybody will see the negative events, as we saw 18% did see an increase, while 33% had their borrowing bases reaffirmed. The spring fears, this is the redetermination that we're coming into. As we discussed earlier, oil prices are lower. Recent EIA forecast has us at $34.28 a barrel for 2016 for Brent, $34.04 a barrel for WTI. The fears of kick the can from the prior two redeterminations, we already discussed the fall one from 2015, but the spring one was also a cause for concern that some of these banks just simply weren't taking the write-downs that they should have been on the names. Oil, as we can see, is expected to remain low. There's a lot of bank regulatory pressures moving forward, too. The OCC, in their semi-annual risk perspective, had oil and energy loans as a key worry for some of the bank spreadsheets and an area that they were looking closer. Obviously, we got the CCAR announcements coming up for the banks, too, where some of these oil and gas loans will be looked at under a closer microscope with more write-downs. How this plays into the appetite for making loans will be key. An increase in the Fed rates obviously is making tougher borrowing conditions. We already had the one rate hike. Tomorrow we'll see what the Fed outlook currently is. We'd expect a 4 rate hike dot plot to come down, but there is still a concern that another 2 or 3 rate hikes could further crimp borrowing conditions. Also, a lot more of these oil and gas names are seeing more rolling off of the hedges, which is a key determinant of the level of reserves that they have. and how the banks make the loan. And then, naturally, a lot of these guys have been cutting back on production and lightly improved reserves. That will also play a factor into it. Now, the companies mainly at risk are upstream oil and gas companies that rely heavily on these RVLs to finance exploration and production activities. Small and mid-cap names will be a particular risk as they have a greater reliance on this level of revolver. Companies are going to need to demonstrate that they do not rely on these facilities, especially if they get their borrowing base cut. Hedging and cash flows will also play a key role, and we could see a lot of these names be forced to sell assets. Now, at the end of my presentation, I'm going to be providing some specific stocks that I'm taking a look at, and these are also names that are going to be in play, and that Scalp and Cont'd I'm sure will be trading at a lot on the site. But first, we're going to take a close look at the second item that's on our list, and that's the Brexit. This is coming up on June 23rd and promises to cause some concern in the market over the next few months. On the site, for those of you that read my commentary, you'll know that currently I'm looking at an upward trend, but I am looking for a greater sell-off in the markets and for us to hit new lows coming up in the next few months. The April redetermination is one leg of that concern. The Brexit is another area of worry. This is basically the vote on whether or not the UK will stay in the European Union. The vote, as mentioned, is expected on June 23rd. Britain is the second largest economy behind Germany in the EU. It makes a very large concern. There's also the OMT borrowing that the UK is wrapped in that could be impacted by this. At the center of the debate is immigration policies that the UK is fighting against, very similar to what we're seeing here in the U.S. Then you also got the special status that the UK is looking for in terms of being able to veto certain decisions. And then regulation, particularly on the financial aspect, which could have a major impact on UK banks moving forward. So the issues that the Brexit may cause, I think the Vodafone CEO basically summed it up perfectly. He said, getting out, I don't think anybody can really explain what will happen. What are the consequences? So I think one is a scenario of certainty and the other one is a scenario of uncertainty. As we've seen in the markets, people tend to sell when they're uncertain of something, and this Brexit will be a key example of this. One thing that comes to mind right off the bat is the trade agreements. There's 53 trade agreements currently set up with trading groups via the EU. These will all have to be renegotiated by the UK. Increased border fees for financial institutions. So, basically, if you're a bank and all of a sudden you are looking to do business in the UK for Germany and you no longer have the EU status, there'll be increased fees that are going to be tacked on. And this is a concern, and this has a lot of people thinking that people might look to exit their financial home base in the UK. We're already seeing people putting boots on the ground in Ireland just to protect against this. But, it's going to be a key concern that could have an impact on some British banks moving forward. Then there's, of course, the geopolitical concern, because this will weaken Europe and the EU as they try to act as a counterbalance to Russian might in the region. ISIS, for instance, China's growth and growing geopolitical impact. We're already seeing President Barack Obama making a visit to plead against the Brexit in the next couple of weeks. That kind of highlights the U.S. idea on this and the geopolitical worries that it has of the event of the UK leaving it. Some other items of interest, too, is the UK relies heavily on foreign investment flows as it is a net exporter. The country is relying on it, and the current account deficit is 4% of GDP, which greatly has to do with investment inflows. So the HSBC has said that the GDP could be lowered by 1.5% in the UK over the next few quarters. Fears Scotland could look to hold its own referendum to leave the UK. This was an issue that hit markets over the last few months, but Scotland voted to stay in. However, a lot of that was due to pro-EU concerns. If the UK leaves, all of a sudden Scotland might decide to hold its own referendum and then leave the UK in order to join the EU. Sterling weakness. We saw on back in early February when London Mayor Boris Johnson basically put his weight behind the Brexit, that the pound ended up getting hit and knocked down about 5% on the day. This led to a 7-year low in sterling as it dipped below the 140 level. There's going to be a lot of great fears of the impact this is going to have on sterling, which could also impact the Bank of England moving forward in terms of they might be forced to tighten rates in order to protect any downfall in sterling. One other thing to keep in mind on this is the Lisbon Treaty, Article 50. So there's going to be a 2-year negotiating period if the UK decides to leave. So this is going to be a lingering issue. And then it's also going to raise questions of other potential EU exits. So, this is going to be a major event for the EU, for the pound, the euro, any companies that are running cross-border heavily with the UK and the EU. So I'm going to provide a list of tickers here shortly. So just to give you a quick look, some of the latest polls in this. You got the YouGov poll, which is 40% stay, 30% leave, 23% undecided. As you can see, this is something that is very much up in the air. Right now, we're currently leaning towards the stay, as you can also see in Ladbrokes, which is a popular British gambling site out there. But it's still up in question, and it could still be changed. And there are other items that could impact it, that could really rattle markets and cause a lot of people to head to the sidelines. So, we're just taking a look at some of these items going through, and we're going to be providing a lot of commentary. Now, here's some trading ideas that are going to be coming from it that I'm taking a look at from these two events. So, for the April redeterminations, as I said, not everything will be negative. There will be some winners in this. There will be some losers in this. One name that I'm looking at in particular is Bill Barrett Corp., which is BBG. They've already announced that they expect a 10% decrease in their borrowing base for the redetermination, but they've really been putting together a strong balance sheet over the past 2 to 3 years. They have a pretty good hedge book in place. Their CapEx needs for 2016 are relatively small, and they do have a solid liquidity position. Some other names that I'm going to be taking a look at that were winners in the fall redetermination were RSPP, which is RSP Permian, Grand Tierra, which is GTE, Gulfport Energy, GPOR, Memorial Resource, MRD, and EV Energy Partners, which is EVEP. Some of the names that we'll be cautious on over the next few weeks. These are already names that have already been getting hit on this. Some of them have seen a bounce back over the last couple of weeks. So, we're really going to be taking a look at to see if they give up the ghost and head back down. But these are also a lot of players that lost heavily in the fall redetermination, such as EOX, which is Emerald Oil. They saw a 40% decline in their borrowing base last fall. Unit Corp, UNT, which saw a 24% decline. SM Energy, SM, they saw a 17% decline. New Source Energy, which is NSLP, they saw a 50% hit to their borrowing costs. So, these are some of the names that I'm going to go into greater detail on the site in the next coming weeks. But I just wanted to give you a couple of tickers at least to take a look at as potential trading vehicles for the upcoming April redetermination catalysts. From the Brexit side, the pound is obviously going to be something we're taking a look at. This is via the FXB. I'll be looking to trade futures on this more, just looking to take advantage of gyrations in the market and oversold and overbought conditions. Recently, we saw an oversold condition on the Boris Johnson comments that provided a tradable opportunity. But, this is going to be more of a macro level event. So ES Futures is going to be another item that I'll be looking at to trade heavily throughout this time and providing daily commentary similar to what I've done in the past. Haven't traded as much futures on the site, but that is something that will be picked up in the next couple of weeks. And I'm sure Chart Trader will have his hands in the cookie jar too, trading away at that as well, taking advantage of opportunities. And then some European ETFs we'll be taking a look at too for longer term swing trades. Then below, here's some tickers of some companies that are based in the UK and should see a lot of gyrations, particularly companies like HSBC, which is a bank there, LYG, RBS, Royal Bank of Scotland, and then just some other names that will be heavily reliant, such as BP, RSD, and Vodafone is another example. And ACHC is another name that I've come across recently, which recently purchased the company and will probably fly under the radar. But they purchased UK's Priory, which gives them a heavier exposure to the UK markets and thus the pound. So these here are some of the names that I'll be going into greater detail on the site in the coming weeks, but I did want to provide you with a couple of tickers to start taking a look at, start getting your head around some of these events that are coming up, and looking for tradable, actionable opportunities moving forward. So that's going to end my part of the presentation. So now I'm going to be turning it over to Dennis Hobein, who will be taking you through a look at the IPO market and where we stand today. So without any further ado, here's Dennis.
Thanks, Gavin. Like Gavin said, I publish under the RVALU and IPOXX tickers. So most of my time here is spent analyzing IPOs and the IPO market, and that's going to be a main focus of my presentation here today. So just to kind of start off with, and I apologize if this is too basic and introductory, but we'll try and get through this part a little bit quicker to get onto some other stuff. But to start with, an IPO is also known as an initial public offering. It's when a previous privately held company offers shares to investors, making its shares available for investment on a public exchange for the first time. I think it's important to know that the motivation for a company going public, it's not always in the best interest of the investors. The ideal situation is when a company is the one selling all of the shares, or at least most of the shares, and therefore they'll keep those proceeds, hopefully for growth initiatives like paying down debt, which obviously helps on the earnings side, financing projects, making acquisitions, launching new products, any number of different things. So that's one of the things that we look for when a company is going public. It's in the beginning of a prospectus. You can see exactly how many shares the company is offering as opposed to selling shareholders. On the flip side, sometimes you'll see IPOs where the company isn't offering any shares. In these situations, it's usually a private equity firm that's looking to cash out on an investment they made, probably several years back, where they bought a company that was maybe distressed or underperforming for one reason or another, so private equity scooped them up with debt, and they feel that they can make some money on their investment now, so they go forward with an IPO. Obviously, in that situation, it benefits the private equity firm, but not so much the company or the investors that are looking to purchase the IPO. So that's something to look for right away when you see an IPO about to launch. On the investor side, IPOs are unique, of course, in that they offer new high growth opportunities with high return potential. The idea here is you're getting in on the ground floor of a younger company that's at the beginning or near the beginning of its growth curve, and hopefully the company has a bright future ahead. So you're looking to kind of get in on that ground floor. Of course, there's also higher risks involved with an IPO. Many times company isn't profitable yet. Losses could actually be accelerating, or they're more sensitive to what's happening in the market and the economy too. So any little change in what's going on in the broader market can just have a pretty drastic effect, as we're seeing right now, of course, with IPOs. Companies of virtually every shape and size go public. So it's not just the smaller up-and-coming companies that you'll see coming through the pipeline. Most of them are, but you'll see prominent companies looking to go public too. But another key thing to realize is just because the company is bigger and is generating more buzz heading into their IPO, that doesn't always translate into a good IPO or better returns, expected returns. The financial media likes to really play up a lot of the names that everybody knows. So there'll be plenty of hype heading into the deal. Groupon, Twitter, Etsy, those are a few that just kind of came to the top of my mind. 3 highly hyped IPOs that pretty much have failed. So that's one of the things that we try to do when we're analyzing an IPO is kind of differentiate between what the buzz is and what the fundamentals are. So that's kind of a goal of what we're trying to do. And then just as in the stock market, trends develop within the IPO market itself. Like right now, we're seeing a trend for biotech and pharma. Almost every IPO we've seen over the last few months have been pharma or biotech. Prior to that, there was kind of a run on cybersecurity, cloud computing. So it's just kind of the cycle that we're in right now. Okay, so now that we've gone over what an IPO is, just kind of walk you through how the process works a little bit. The first thing the company obviously has to do is find an investment bank to structure and market the deal. The number of investment banks involved in a deal fluctuates, and it's pretty much a function of the size of the IPO itself. So, if you see a $1 billion IPO coming through, there's not just going to be one lead underwriter on it. You're probably going to have 4 or 5 or 6, sometimes even more. And the firms, the investment banking firms, they earn a commission based off the total proceeds that are generated. So that's why sometimes you'll see something posted that gives a net proceeds from the IPO and something that says gross proceeds. There's a difference there, and the difference is simply that the net proceeds takes out the commissions generated by the investment bank. So after the company has chosen the investment banks to work with and hired them, the next step for them is to basically get all their financials together and any other relevant information that the investment banks are going to need to work on and draft a prospectus. Prospectus, for those who aren't aware, another name for it is S1. Very lengthy report, heavy on the legalese, so if you ever need some nighttime reading to fall asleep, you might want to take a look at a couple of those. They detail every single aspect of the company looking to go public. It's a requirement. They're reviewed by the SEC before they get distributed out, and it's basically the first and main source of information that potential investors will have access to. Between the time the first prospectus goes out and the actual IPO date, there's likely to be several amendments. That's to the original S1, and the reason is because it typically takes a few months for a company to prepare to go public. So you'll see S1As come out, and most of the time these just include updated financial information. Like if they had another quarter go by, they'll include the most recent quarterly results in there. Okay, so once the prospectus is all put together, the next step for them is to go on the roadshow. It's another term you might be familiar with. This is basically where the upper management of the company travels across the country, visiting large institutional investors, pitching its IPO. If anybody's ever watched one or seen one, it's pretty heavy on the fluff and the marketing. You'll see some presentations usually where they're interviewing customers, saying how great and awesome the company is, etc. But you also get every once in a while a new nugget of piece of information out of it that might not have been included in the prospectus. So they're still worth. It's still an important part of the analysis. So as it comes to the end of the process here, the investment bank now will call around to all those institutions that they visited and kind of get a feel for investors' interest in the deal. And from there, they can kind of get a good idea of what investors are going to be willing to pay, how many shares they're going to want to purchase. So they're able at that point to kind of get the specifics of the deal, start putting that together, and then they'll have a better idea on the date as well. But that doesn't mean that it's set in stone. That first expected price range and the number of shares that they announce, that's definitely not set in stone, because the situation changes from the time that they come up with that until the time of the IPO goes. It just could be a very highly hyped or anticipated IPO that has people enthusiastic. One term you might have also heard is oversubscribed. Basically, all that means is that there's more demand than shares are made available. You can see it 2 times, 3 times oversubscribed. And then, so once the final price is set, the next step is the investment bank actually buys all the shares. So the shares aren't coming from the company itself. The investment bank actually buys the shares, but then their intention is to sell them, or at least most of them, to the institutional clients that were interested in the IPO. Another name for this market is the primary market. And then right before the IPO launches, you'll have the IPO price that represents what the institutionals finally paid for the shares, and then the IPO will begin trading sometime after the opening bell. For a New York Stock Exchange stocks, it's usually within the first 30 to 45 minutes. It's a little longer for NASDAQ, and it's definitely not as predictable for when a NASDAQ IPO will open. There's a little more fluctuation there. Okay, so then the first trade will fire off, and this is the opening price, and it's important to understand that that's not the same as the IPO price. The IPO price, again, is what institutions paid in the primary market, whereas the IPO opening price is the first trade that was made in the public market or the secondary market. It's pretty rare for an IPO to open at the exact same price as the IPO price. Hot IPOs could open with double or triple digit premiums, but that's not something we've been seeing very frequently lately. This is the term for that is opening pop or premium, either or. Just a couple examples this year. Biogene and Edit, those were the rare exceptions that opened with some pretty big opening gains. Again, those are also biotechs, which is really the only sector in the IPO market that is active at this time. Going back a couple of years when the IPO market was much healthier, it was definitely more prevalent where you'd see IPOs opening with some pretty solid gains. Some at that time were speculating that maybe there was a bubble in the IPO market, and a lot of those that open with big pops have come down quite a bit since then. When that happens, when you see an IPO open with a huge opening pop, it's a good news and bad news thing. The good news is, obviously, for the IPO investor, they just made immediate gains, sometimes significant. But on the other side of the coin, the investment bankers, they underestimated demand, and what that does is basically the company didn't generate as much capital as they could have. So for the company, it's not such a good deal. Obviously, IPO can open at a discount too, which has been fairly common recently, putting institutional investors underwater. Investment bank they'll try and support the stock as best they could by buying it in the open market, but that's not always successful, as market forces are usually pretty strong. If there's enthusiasm against an IPO, usually the market wins out. The key support price for the IPO is the IPO price. If it breaks below the IPO price, it's basically called a busted IPO, a broken IPO. Another key thing to look at for an IPO is the float, and basically that's just the number of shares that are available for trading. It's different from shares outstanding. The company still can be holding on to any number of shares, but the float is the amount that was involved in the deal. So if you see an IPO that has a smaller float of, say, like 5 or 6 million, and there's some serious enthusiasm behind it, those IPOs can really, in a good market, those IPOs could really take off quickly. So that's another factor that we keep an eye on. Flippers may sell immediately depending on opening price and repurchase in the same day. This creates some volatility on the first day, especially for a lower float deal. And for this reason, I think for a lot of investors, especially for longer term investors that aren't looking to make, the scalp 25, 50 cents off a trade, the safest play is usually to kind of avoid that first day volatility. We do have traders here that do it, and Scalp is very good at it. So he's somebody to watch when the IPO market resumes. It's healthy again, but it's just very easy to get whipsawed out of it on the first day. So one strategy that I've implemented, like in the past, is in a softer market, taking a look at some higher quality IPOs that priced poorly and acted badly out of the gate, and then kind of fell off people's radars and started forming a base, and volume might have dried up, but at that point, kind of taking another look at it and maybe start accumulating some shares. I would say, it differs, but I would say maybe, a couple weeks out from its IPO date where it's completely forgotten about. And then, if it's a fundamentally strong company, you might have a couple catalysts ahead with the quiet period expiration and then the first quarterly earnings report. So maybe interest might start perking up in the stock as those two key dates approach. Okay, so moving on to our coverage here. It's an area that we have really focused more on over the past few years, and I feel pretty strongly that it's one of our competitive advantages here. It's pretty hard to find a more premium service that focuses as much, puts the emphasis on the IPO market like we do. For those that haven't really followed the IPO market too much or are new to our site, all of our IPO coverage it can be found under that IPOXX ticker. And our coverage can really be kind of categorized into two areas: news and our analysis. From the news standpoint, you'll see us post headlines when a company announces their IPO plans for the first time, and then when the terms come out for that IPO. If there was a change in the terms, we'll publish that, and then of course when the IPO prices, where it priced relative to expectations, and then when it opens for trading. In terms of our analysis, you can access that via the IPOXX ticker, but also we have an archive of the next big thing, and I'll show you in a slide or two, actually the next slide, how you can find that. For the next big thing, we publish a week ahead report on Friday afternoons typically, where we provide in-depth previews for upcoming IPOs. Some of these IPOs will be graded A through F, although I don't know that we've ever given an F, but those we just didn't grade outright. I have another slide where we'll go into more detail on the week ahead. And then once a company goes public after its IPO, we'll highlight certain IPOs that are making significant moves, or maybe a significant event happened, such as earnings. On February 9th, we published a report on Sabre after their strong earnings. Editas Medicine on March 3rd, which is a biotech that has just skyrocketed, but we kind of put a little bit of a warning out after that move, saying that the parabolic move will come to an end eventually, that the snapback could be fierce, and the stock did pull back quite a bit. From time to time we'll offer some trade recommendations on the IPOXX ticker, but this is basically transitioned more to the RVALU ticker, which I'll get to in a little bit. There's also an IPO calendar located on the calendars tab, and just scrolling down to IPO. On the calendar, we have what's ahead for the next few weeks. We provide a short description of the company, how many shares they're offering, and the expected range. And as IPOs go, as they launch, or as terms change, or whatever, the calendar gets updated and populates with new information. Also on that calendar, there's a quiet period and lockup tab in the upper right-hand corner. For those that aren't familiar with the quiet period term, basically it's a 25-day period in which investment banks that were involved on the IPO are restricted from publishing analysis. So after that 25-day period expires, you'll probably see a rush of initiations, and that can act as a catalyst for the stock if sentiment comes out bullish on the IPO. In lockups, that's usually a 180-day period in which insiders at the company, upper level management, are restricted from selling their shares. So obviously after the 180-day period is up, it's possible that a new supply of stock could be coming on the market. Oftentimes the stock will move ahead of the actual lockup date, as traders are aware that's coming, so they're looking to exit, kind of a selling ahead of the event situation. Okay, so on this slide, this just is showing you where to access the next big thing archive. On the in-play page, just clicking on investing and trading, scrolling down to the next big thing. And on this page, this is just showing you how to access the IPO calendar. Again, it's from the in-play page, clicking on the calendars tab and scrolling down to IPO. All right, as promised, I said that we'd focus a little more on the week ahead report. This is kind of the flagship piece of analysis for the next big thing. Unfortunately, because the IPO market has been so quiet for the last few months, there just hasn't been a whole lot of previews to do. But in this report, which is published on Fridays, we'll do a fundamentally based preview for each IPO coming up. Obviously, it's fundamentally based. There's no trading history to make any technical analysis on. And the analysis we do, it's very similar to how you would analyze any publicly traded stock. There's some subtle differences, such as the types of sources that we use. Like I said before, we're heavily reliant on the S1 and the Roadshow to analyze these. And there's other considerations such as the deal itself, how many shares are being offered, who's offering the shares, who the lead underwriters are. So there's a couple other considerations that need to be made. But generally, this list below, this isn't all inclusive by any means, but what we're looking at is what the company does and its business model. In regards to that business model, one thing that I like to look at is the sales and marketing expense as a percent of revenue. A red flag to me sometimes is if you see that increasing as it goes quarter to quarter. That's kind of telling me that the company's having to invest more and more money in order to get customers interested in buying whatever they're selling. So that could be a clue that their business model isn't operating as they would like. Of course, the competitive situation we'll pay close attention to. The underlying trends within its markets, what's the CAGR looking like in the markets that it's operating in, the specific growth potential for the company and its strategy. As I said before, in the S1, there's a lot of boilerplate language. They have a specific growth strategy section. Sometimes it kind of almost seems verbatim, like we're going to make acquisitions or we're going to launch new products. But sometimes companies do get a little bit more specific in there, and that's obviously preferable because you get a better idea of what the catalyst could be going forward. We'll obviously take a close look at the financials that are available. Sometimes, depending on how young the company is, there might not be a whole lot there to take a look at. But when there is, some of the key things that I'm looking at is the revenue growth trend. Is this company still in the upswing of its growth, or has it kind of topped out and now they're they're cashing out or going public at a time when the revenue growth is going the other direction? Margin trend, that could tell you things about pricing pressures, the competitive situation. Ideally, you want to see gross margin on the rise. Profitability, a lot of companies aren't yet profitable when they go public, but what I at least want to see is losses are shrinking. If you get a situation where revenue growth is kind of stagnant or slipping a little bit, and the company's losses are widening or not improving, that's a clear red flag too. Cash flow, probably more important metric actually on the profitability side is taking a look at the company's cash flows. On the balance sheet, how much cash does the company have before it's going public? What's it going to use the proceeds for? Is it to pay selling shareholders? Is it to offer a dividend to executives, or are they going to use their IPO proceeds to fuel its growth? And then, of course, the valuation. In terms of coming up with forward metrics on valuation, there's no analyst estimates available yet. The company hasn't issued any guidance yet. So in order to come up with an idea of what their forward valuation would be, kind of just have to go off of what the recent growth rates have been, and come up with your best guess on that side of it. And then I'll take a look at recent peer performance from two angles. One, how have these companies been performing in terms of their earnings? Have they been outperforming, underperforming? That will give me a clue as to what to expect when the company does announce their quarterly earnings for the first time. And then secondly, how the stock's been performing? Is it a hot area? Is it a cold area? That will give a gauge as to what investor interest and enthusiasm will be once it starts trading. And then I've mentioned this already, the deal specifics. Underwriters, it's preferable to see tier 1 companies leading it, like Goldman, Morgan, Deutsche Bank. That's just kind of a little indicator of the general quality of the IPO. The float, like I said before, I think it's, in my experience, it's been preferable to see the float kind of in that mid-size range, like 5 to 15 million. A little smaller than that, and you're getting into the lower quality IPOs. And then anything that's larger than that, well, maybe a little bit more than that. It can get bogged down. You could have too much supply. It could be kind of hard to get the stock moving. So the analysis of these items form the basis of how we grade them. We place an emphasis on the growth potential. A lot of IPO investors, that's what they're looking for. They're looking for the best growth stories that are out there. But at the same time, we want growth. We want to see growth, but still a realistic valuation in terms of how the IPO market has been pricing deals. And a key point here I want to make, obviously, with the italics and underlined, is grades are not based on current market conditions or what we assume may happen in the future. They are based solely on the company's fundamentals at that specific time we publish the report. I wanted to include this because sometimes we'll get people that, a stock will make a 60% move a few months out, but our grade at the time the IPO launched was, maybe like a B- or C+. But at that time, their financials might have been weak, and in between then and a few months out, things could have significantly changed. Maybe there was an acquisition, or maybe their financial results came in better than they expected, or they launched a new product, any number of things. So our grades then, they can best be used as a gauge to determine whether investors should consider an allocation in the actual IPO. Or if that's not possible, and assuming the stock doesn't make a skyrocket move over the first few days, whether it's worth taking a look at after it opens for trading. Not every IPO we look at will have a grade. The reason for this is, this is especially true right now, a lot of biotechs and clinical stage farmers, there's no financial history, there's no financials, period. So the basis of our grades they're heavily weighted on the recent financials, so that makes it difficult to put a grade on them. But what we will do is include language in our previews about, say the company was involved in cancer, had a cancer-related drug like immuno-oncology or something. That's been a hot sector, so we might include some language in our preview saying this IPO could do well because of the area of expertise that it's in. Okay, on this slide I'm providing you an example of a way to use our analysis. In this example, I'm taking Atlassian, which was an IPO from last December, one of the last non-pharma, actually, IPOs to go public. So on December 4th, we published the preview for it in the week ahead report. And it was an IPO that we graded strongly with a B+. Has strong growth, was profitable, which is rare for a software company going public. Smaller float, strong underwriters. So in our preview, we recommend securing an allocation in this one. Ended up pricing well at 21, above the original range of 19 to 20, and opened with a pretty good pop of 32%. Then after its IPO on December 15th, which is that first red ellipse there, we published a follow-up report saying that team was worth another look here for those that weren't able to secure an allocation in the IPO after some profit taking had hit it. And then about a week later, on December 21st, after the stock made a 12% move, we said it might be time to lock in some gains on that. And then again, on February 3rd, which is the last ellipse there, published another report on it ahead of its Q2 report, suggesting that might be time to take another look at it again. And on that day, the stock made an 8% gain, and again, we suggested taking the money, especially given the market conditions. So, and this is an example of how you can use the analysis both from a pre-IPO and post-IPO perspective. So, the state of the IPO market. Anybody that's been following the IPO market knows that it's struggling, and that's putting it mildly. It's essentially broken right now. It's not a situation in which IPOs are even pricing. It's a situation where deals are almost non-existent. There have been only 6 so far this year, 5 of which are healthcare related, which puts us on pace for 72. That would be the lowest total since 2009, 63, which of course was right at the end of the financial crisis. At the end of February last year, there were 24. At the end of February 2014, there were 37. So that gives you an idea of what we're looking at currently. So what is the issue with the IPO market? It basically comes down to volatility and fear in the broader markets. Those are the 2 things that the IPO market hates the most. IPOs, of course, are perhaps the riskiest asset. So when there's fear in the market, it's going to be the first asset class that really gets shunned. So that's pretty much what's going on. Investors have been in a risk aversion mood. You've seen small caps getting hit harder. Recent IPOs that have gone public, a lot of them have been crushed. So the risk assets have been getting hit the hardest, and that's what's keeping a lid on the IPO market. Another factor, though, is that over the past few years, there's been a surge in IPOs, about 450 in the 2 years of 2014 2015. So there could be a little investor fatigue coupled with the risk aversion going on. What it all boils down to, though, is no company wants to launch an IPO only to see it get hit hard immediately, taking its market cap down with it, and no investor is going to want an IPO and be immediately underwater on it. What's the outlook? Right now it's unclear, but I would say improving. The broader markets have rebounded recently. This hasn't spurred activity yet in the IPO market, indicating that there could be some worries that are persisting. But if the market continues to hang on and perform like it has, it's bound to recover here shortly. And you could already see the pipeline building up, and actually on the IPO calendar, a few more have been popping up on there. So it feels to me as if we could be at an inflection point where things start to turn around here. Pharma and biotech IPOs, they continue to be the one outlier. These are not economically sensitive companies, and there's a couple big new technologies in this area, like gene editing and CAR-T for cancer research, that are leading to new development opportunities that are making investors feel pretty enthusiastic about that sector. So I also published commentary under the RVALU, relative value ticker. My goal and what I'm seeking to do, or my philosophy, is basically to identify stocks that are trading at a relatively lower valuation that display compelling growth potential and have growth catalysts. In short, it's growth at a reasonable price strategy. This is different from pure value investing, whereas those investors are kind of looking, our bottom picking might be a meaner way to put it, but they're looking for just rock bottom valuation stocks that have been decimated and kind of looking for the bottom. The stocks that I'm looking at, they may trade with metrics that look a little richer on the surface, but then when you compare them to their peers or their growth prospects, the stock will look relatively cheap. Again, there's that word relatively. My focus is mainly on the fundamentals, the growth versus valuation, strength of balance sheet, which direction are its trends going, what's the competitive landscape like, with a special emphasis on trying to identify turnaround stories. A recent one that I published was Mobile Iron, MOBL, and that company has put together a few really fairly strong quarters, much better than what they had been doing last year. There's some new management at the company. They've initiated some cost-cutting initiatives, and that company seems to be in the early stages of a turnaround. It's one that I like quite a bit. I do use technical analysis as well, seeking to identify areas of support and resistance, trends in the moving averages, possible pattern breakouts, and or reversal patterns, I should say patterns, and candlesticks. I take a longer-term approach compared to other traders here, generally looking a couple quarters out at least. So I'm not as active either. I'm not trading on a daily basis. So generally, you're not going to see 2, 3, 4 trades from me a day. I take a selective approach and a longer-term approach to what I'm looking at. Previously, I've used the week ahead and IPOXX to uncover a lot of my ideas. I've already done a lot of the heavy lifting in terms of the research on those names, so I'm already pretty familiar with them. I kind of hit on this earlier, but a successful strategy that I've used is accumulating shares of beaten down IPOs that were hit mainly from market weakness or solely from market weakness. The most dramatic example I can think of in that scenario was Ambarella, which makes the chips for GoPro and security cameras, etc. That company went public in 2012, priced terribly. There was no enthusiasm at all for that IPO. And I remember financial media tabbing it as just a second-rate semiconductor company. But we felt the fundamentals were very strong on that one. We actually graded it pretty well with a B+. And then in 3 years, the stock gained 2,050%. But right now, as it stands, the volatility in the market has been working against recent IPOs. So I haven't been able to focus my attention too as much on the ideas generated from the week ahead. It's just a very challenging environment. So the recent trades that I've initiated, all of those have come from screens that I've set up, kind of a growth versus valuation with some technicals also included in the screens. But my intention is to return my focus back on IPOs to generate ideas for RVALU when the IPO market is healthier. And lastly, one IPO that I kind of have my eye on, recent IPO that I have my eye on right now is Shopify. The company's been, it got crushed over the last few months, but it's been working its way back up after its strong fourth quarter. And what really stood out to me was that its revenue growth is actually accelerating and near 100%. You just don't see that very often with a company that recently went public. And it is still not profitable yet, but the losses are shrinking. and as of right now, it's on track to be profitable next year. It does have a little bit higher valuation, but again, relative to its growth, accelerating growth, I feel that the valuation is justified and tolerable. And lastly, the stock is, from a technical perspective, rallied above its key moving averages, so the stock is trending in the right direction. So that wraps up our presentation today. Thank you very much for hopping on the presentation. If there
just to follow up, if there's any follow-up questions, we're more than happy to answer them. There's a few already in line that we'll answer on the site, and basically just fire them off either directly to us via the emails that you see above, gmaguire@briefing.com or Dennis or Hobein@briefing.com. You can also send it to the Briefing Trader team at briefingtrader.com, and then there's always the Talk to Us button as well. But feel free to fire off any questions you have. I know a few of you are looking for copies of the webinar that we'll be happy to send off to you. And we'll be discussing all these events going along the next few weeks as well. But definitely, please feel free to follow up with any questions if we left anything out, or if there's anything that you're curious on, or anything that you'd like to see touched upon a little bit more in depth. So we definitely want to thank you for joining us today. And with that, we'll be bidding you guys goodbye. And like I said, follow up with any questions, and we'll get off the presentation slides to anybody that's looking for them. Have a good day, and thank you very much.
Thank you.